Hello and welcome to Morning Call. I'm Lata Venkatesh. With me is Sonia Shenoy. We kick off actually a fairly heavy week today. Although this is going to be a truncated week with one trading holiday, it's going to be heavy for a bulk of reasons. One, there is this unscheduled Fed meeting today where the discount rate could be hiked. So we will come to what is the difference between the Fed funds rate and the discount rate, but it's just a worry that sits on your head. And then, of course, we have to react to some of the Friday evening cues that we got. One is that the Indian taxes roadmap was laid for removing all exemptions, investment-related as well as profit-related, and for the eventual introduction of a 25% corporate tax rate. So there is that confusion and worry that will stay on the minds of investors. Plus, the Seventh Pay Commission, well, most of it was known, but the nitty-gritty numbers are now with us after the paper on the Finance Commission's website, and that will be another load on the market. And as if all this was not enough, it's expiry week.
Yes.
So it becomes an ominous week. Too many things for the market to tackle this Monday morning.
Oh yes, Lata, good morning. And it could be a very volatile week as well, something that we saw last week too. But give and take everything, apart from that unscheduled Fed meeting, the global cues are positive as we get into trade. The SGX Nifty, in fact, is suggesting that the start could be on the green side. And even if you look at the, the S&P 500, it was up 3.3% last week. So it put behind it a very strong week. And a lot of Asian markets are positive this morning as well.
I would be a little skeptical about whether this will continue. It might, but we must note that after the Fed funds, the Fed meeting was announced, the market actually ended off the day's high on Dow Jones itself. So there was that worry, and the market didn't have the time to interpret that news adequately. Now, Asia will not react to that so much as Europe will. And Europe had its own worries. So, this statement on top of it is likely to perhaps lead to a no action. At least the upside could be capped going into the meeting itself later today in the United States. So I'm not very sure that the global cues are going to be very positive. They may not be negative. It may be a wait and watch situation. But ahead of a Fed meeting, I don't think the markets will have the guts to put on too much weight.
Okay, and for the local cues, what are you expecting?
Well, local cues are, obviously the FNO cues are going to dominate because that's the most immediate cue. And here the rollovers have been weak against a normal D-3, the last date -3 rollovers, which are normally over 20%, 23%, I think the last month was. This month, the rollovers have been 18%, the overall market rollovers. So the market, to that extent, is a little heavy and has to do some heavy lifting. And the cues that have come are not necessarily very bright. One of them is, of course, this corporate taxes. The other one is the Seventh Pay Commission. And one big takeaway from the Seventh Pay Commission is that for FY17, next year's budget, there is a 0.7% of GDP load in terms of salaries and pensions. That is the very least. It could be even a little higher. And along with it also comes the Seventh Pay Commission's proposal that HRA, house rent allowance to government employees, is up by 109%. Now, some of that, even if you assume 5% of that is taken in when you count the CPI, the CPI for Jan 2017 could well go to 6%. The RBI was expecting in the previous Santa Claus policy that it would go down to 4.8%. So if it doesn't go to 4.8, if it's going, anywhere towards 5.5, I don't see how the Reserve Bank will have any more scope to cut rates. And the market will have to come to terms with that today and in the days to come. So I wouldn't be surprised if the market were a bit preoccupied today, both with rates and with taxes and with a Fed meeting that looms much earlier. Now, I think we have a guest actually joining us. George Huge, the global investment strategist at State Street Global Advisors, joins us on the phone line from New York. George, good evening to you. Thank you very much for staying up for us. Well, what do we do with this meeting? It's completely confusing and out of the blue. What should we expect?
Well, I think we should expect an increase in the federal funds rate, which will be the first increase in several years. And the U.S. economy, relative to other economies, is performing quite well. We're close to full employment in the United States, and the market anticipates at the 70% probability level an increase in rates, and that's our view as well.
So you're expecting the rate hike today?
No, I'm talking about the meeting in December.
Okay, no, I'm asking you about the meeting today. How important is it and what should we expect? Today, as in it'll be tomorrow for you.
I don't think we should expect any change in current policy at this point.
Okay. George, morning. So how do you approach emerging markets since you are a global investment strategist? We have seen some money getting pulled out of emerging markets in the recent past. Given that the Fed rate hike is, on the anvil, do you expect more money to be taken off the table?
I do, actually. Emerging markets face both cyclical and secular headwinds. Now, India, of course, is the standout in emerging markets in terms of macroeconomic performance. But China is larger. The Chinese economy is larger than India, Russia, and Brazil combined. So we have the normalization of U.S. interest rates gradually, but over several quarters. We have a slowdown in global trade. We have continued weakness in commodity prices, and we also have dollar strength. So the growth rate between emerging markets and developed markets growth rates now is the narrowest. The gap is the narrowest it's been in several years. We've more or less reached bottom in terms of outflows, but I still think there's some more to come, and we continue to be very cautious on emerging markets.
Okay. George, let me come back to this unscheduled meeting on Monday by the Fed. We needn't worry at all. Would there be a hike in discount rate, as some blogs seem to be guessing?
I don't believe so. No, I think that there's disagreement, as you know, and I think among Fed governors, and I think that any increase in rates will be done in December.
So this meeting would be a non-event? It's not something the market should worry about?
Well, I wouldn't go that far, but I just don't think that. I don't believe that we're going to see an increase in rates then.
Okay, and finally then, before we let you go, your view on India?
Well, as I mentioned, India its macroeconomic performance has increased substantially over the past 36 months. The current account deficit has come down. India has been a major beneficiary of the oil price decline. Inflation is coming down in India, but India continues to face large structural problems, as you know, relating to infrastructure, foreign direct investment, and the policy agenda has been set, but investors are looking now more for implementation. But I would say that India is benefiting from an improved perception among global investors, particularly because there's substantial uncertainty as to what the trajectory of the Chinese economy will be in the next 24 to 36 months.
Fair point. George, finally, if the market is preparing for a 70% chance of a rate hike on December 15, 16, would you expect a lot of volatility in currencies? Would you expect capital flows out of emerging markets in the run-up and thereafter?
I think that's pretty well in the price. I think what really matters is the pace at which subsequent increases come. We actually see 4 rate hikes next year, and the Fed funds rate at 1.25 by the end of next year. But if we went back for whatever reason, which is not our core scenario, but if we went back to a 94, 95 type scenario where the Fed tightened much more rapidly than the market anticipated, then definitely we would see more money coming out of emerging markets. We also have to bear in mind that there are some countries like Turkey, the twin deficit countries like Turkey and Brazil, who are potentially vulnerable in this environment. And in the case of Turkey, it's obviously compounded by the ever-widening conflict in Syria and the prospective establishment of an independent Kurdish state. So there are many factors at play, and the situation varies significantly country by country.
Fair point. George, thank you very much for joining us this evening. Okay, so the first takeaway from State Street is that we shouldn't worry too much about today's meeting. Let's hope that the markets will interpret it that way, but I would still think that there will be an upside cap today.
All right, so let's tell you